blockbuster release.
Panama Papers.
Turned out of the banking bombshell causing shockwaves around the world.
Edward Snowden calling it the biggest leak in the history of data journalism.
Panama City, 2016. A journalist opens a file labeled Client Onboarding Final V3. Inside, scanned passports, shell company charts, and handwritten notes that all say the same thing without ever saying it out loud. Hide the money. No drugs, no guns, no bodies, just documents. And yet this system drains more wealth from governments every year than all street crime combined. This is the story of the cleanest crime on earth. A crime without sirens, without prison sentences, without handcuffs. A crime so normalized that it isn't even called a crime. This is offshore finance, the global machine that allows trillions to disappear legally, invisibly, and permanently. Most crimes fail for a simple reason: they break the law. There's a clear violation, a visible victim, and at least in theory, a path to punishment. Offshore finance works differently. It succeeds not by breaking the law, but by hiding inside it. The law isn't an obstacle. It's the camouflage. There is no dramatic moment where money is stolen, no vault is breached, no alarm sounds, no trigger is pulled. Instead, something far quieter happens. Wealth is reclassified, re-registered, and relocated. It moves from places where it is taxed, regulated, and accountable to places where it becomes legally invisible. The money doesn't disappear, it simply changes its legal address. On paper, everything looks compliant. Forms are filed, lawyers sign off, banks process the transfers. From the outside, it appears clean. From the inside, it's devastating. The result isn't abstract. Governments quietly lose revenue, not because taxes were evaded illegally, but because they were never owed in the first place. Public services shrink as budgets tighten, forcing cuts to healthcare, education, and infrastructure. Inequality hardens because those with the means to move wealth escape obligations that everyone else cannot. And no one goes to prison because nothing illegal happened. That's what makes it the perfect crime. There's harm without a criminal act, loss without theft, victims without a perpetrator. Justice systems built to punish violations find themselves powerless against compliance. The word offshore is often misunderstood. It doesn't mean illegal. It doesn't even mean secret. It simply means elsewhere. An offshore structure is a legal entity, most often a shell company or a trust, registered in a jurisdiction specifically designed to be attractive to outside wealth. These jurisdictions share a few defining features. They ask no questions about where money comes from. They collect little or no tax on it. And they offer layers of anonymity that make ownership difficult and sometimes impossible to trace. On paper, everything is lawful. The company exists. The trust is registered. The filings are submitted. Nothing is hidden from the system because the system itself is built not to look too closely. That's why places like Cayman Islands, British Virgin Islands, and Panama matter. They didn't invent corruption, tax avoidance, or financial secrecy. Those existed long before. What these jurisdictions perfected was plausible deniability. If no one is required to ask who owns what, then no one can be blamed for not knowing. The money itself never disappears. It still earns interest. It still buys assets. It still influences markets and politics. What changes is its relationship to accountability. Once offshore, wealth exits the reach of tax authorities, regulators, and often the public entirely, without ever breaking a law. So offshore finance isn't about hiding money. It's about relocating it to a place where responsibility no longer follows. The money doesn't vanish. It simply exits accountability. At the center of offshore finance sits its most important invention, the shell company. Not a business in the traditional sense, but a legal mask, complete with paperwork, signatures, and official registration. A shell company has no employees. It produces no goods. It provides no services. It doesn't innovate, sell, or build anything. Its sole purpose is ownership. That single function makes it extraordinarily powerful. A shell company can own other shell companies. It can hold bank accounts, yachts, and private jets. It can sit on top of real estate portfolios, investment funds, and entire operating corporations. On paper, it looks like a legitimate entity. In reality, it exists solely to stand between assets and people. This is where the magic happens. When authorities ask a simple question, who owns this? The answer is never a person. It's another company. That company, in turn, is owned by another entity, registered in another jurisdiction under a different legal framework. Each layer adds distance. Each layer adds delay. By the time investigators reach the end of the chain, the trail often leads nowhere actionable. Not because the owner is unknown, but because responsibility has been spread so thin that it effectively evaporates. No single entity controls enough to be accountable. No individual appears close enough to be liable. Nothing here is accidental. Shell companies are precision tools designed to absorb scrutiny and redirect it endlessly. Every form is filed correctly. Every rule is followed. Every signature is real. Responsibility doesn't disappear all at once. It dissolves, layer by layer, until ownership exists without an owner anyone can touch. In 2016, the offshore world experienced something it was never designed to survive: visibility. An anonymous source leaked 11.5 million internal documents from the law firm Mossack Fonseca. The investigation that followed became known as the Panama Papers. What the documents revealed wasn't shocking because it exposed something illegal. That's what made it different. It was shocking because it exposed how normal this system was. The files showed offshore structures being created, managed, and recycled at an industrial scale. Forms were templated. Shell companies were mass-produced. Clients weren't treated as exceptional cases. They were processed. And those clients came from everywhere. Politicians, billionaires, celebrities, criminals, heads of state. People with radically different public roles, reputations, and sources of wealth were all using the same legal machinery. The same shell companies, the same trusts, the same secrecy jurisdiction. That's when the pattern became impossible to deny. Offshore finance didn't distinguish between dirty money and clean money. It didn't ask whether wealth came from corruption, crime, inheritance, or innovation. Those questions were irrelevant. The system wasn't built to judge. It was built to root. If the paperwork was correct and the fees were paid, the service was provided. The Panama Papers didn't reveal a conspiracy. They revealed infrastructure. A global legal system quietly optimized to move money out of sight, regardless of who owned it. What looked like abuse was in fact standard operating procedure. This entire system survives on one crucial distinction, one that sounds technical, boring, and harmless, but changes everything. Tax evasion is illegal. Tax avoidance is legal. Offshore finance lives in the narrow, carefully engineered gap between the two. It doesn't rely on breaking rules. It relies on redefining what the rules apply to. Accountants and lawyers don't smash laws head-on. They design around them. They read statutes the way engineers read blueprints, searching not for meaning, but for load limits. If a law says profits are taxed where they're earned, they ask a different question. Where can profits be said to exist? A corporation shifts profits through internal transactions, selling services, licenses, or loans to itself across borders. On paper, the money simply moves to a subsidiary in a low-tax jurisdiction. A billionaire relocates intellectual property, patents, trademarks, algorithms, so that value technically lives offshore, even if the business doesn't. A trust is created that owns everything, while no individual legally owns the trust itself. Control exists, responsibility does not. Each step is defensible, each document is valid, each signature is real. And yet, the outcome never changes. Taxes disappear, not because they were stolen, but because they were never triggered. Accountability evaporates, not through secrecy alone, but through compliance. Governments can see the transactions, but they can't challenge them without rewriting entire legal systems. The paperwork is flawless. That's the shield. Offshore finance doesn't run on paperwork alone. It runs through banks. Without them, shell companies are just names on a registry. With them, those names gain accounts, transfers, credit, and global reach. Major financial institutions provide three things that make the system function. First, account access, the ability to move money across borders instantly and at scale. Second, compliance cover, documents, reviews, and certifications that signal everything is in order. And third, plausible ignorance, the carefully maintained distance between what is known and what is required to be known. Historically, banking secrecy made this possible. In places like Switzerland, secrecy wasn't a side effect of finance, it was a selling point. Anonymity itself became a product. Numbered accounts, strict confidentiality laws, and criminal penalties for disclosure turned privacy into protection. That world has changed, at least on paper. Formal secrecy laws have weakened, international pressure increased, reporting standards expanded, but secrecy didn't disappear. It was outsourced. Today, anonymity is achieved not by silence, but by structure. Ownership is buried under layers of companies. Responsibility is shifted to intermediaries. Banks no longer promise secrecy, they promise compliance. And compliance doesn't ask whether money should be there. It asks whether the form is filled out correctly. Banks rarely ask why. They ask whether the client passed a checklist, whether the documents match, whether the entity exists legally somewhere else. If those conditions are met, the transaction proceeds. Suspicion isn't required. Curiosity isn't rewarded. Offshore finance is often described as a loss of money. That framing is too small. This system doesn't simply steal revenue from governments, it steals capacity. The ability of a state to function in the first place. Capacity to build and maintain infrastructure, roads, bridges, power grids, and water systems that don't attract private investment, but are essential for daily life. Capacity to fund healthcare systems that treat people regardless of income, rather than only those who can pay. Capacity to educate entire populations, not just elites, creating long-term stability instead of short-term growth. And capacity to stabilize economies during crises, when public spending is the only thing preventing collapse. When offshore finance drains that capacity, the effects compound. Governments don't just run out of money, they lose options. Choices narrow. Long-term planning gives way to austerity, delay, and neglect. And the burden doesn't disappear, it shifts downward. When the wealthy legally disappear their taxes, governments still have bills to pay. So consumption taxes rise, public services shrink, fees replace funding. Ordinary people make up the difference, paying more for less, while those with the greatest resources contribute the least proportionally. This is why offshore finance isn't victimless. Its harm isn't explosive or visible. There's no broken window, no crime scene tape, no single moment of loss. Instead, the damage accumulates slowly. In overcrowded classrooms, understaffed hospitals, crumbling infrastructure, and fragile economies. The victims don't get headlines or court cases, they get constraints. Offshore finance doesn't need to rob a vault to cause harm. It only needs to quietly hollow out the systems everyone depends on, while remaining perfectly legal. Because the system is self-protecting. Politicians benefit from it. Corporations depend on it. Regulators rotate into it. Enforcement agencies chase individuals. Offshore finance is structural. You can arrest a drug dealer. You can't arrest a spreadsheet. Street crime is punished harshly. Financial crime is explained patiently. One is framed as moral failure, the other as optimization. The more complex the crime, the less personal the blame. Offshore finance didn't eliminate accountability. It priced it out of reach. Trillions now sit offshore, untaxed, unmoved, untouched. Every government knows where the money is. Every government knows how it works. And yet the system persists, not because it's invisible, but because it's useful. Offshore finance doesn't look like crime because it doesn't feel like harm. There are no victims screaming, no alarms ringing, no prisons filling, just schools that don't get built, hospitals that don't open, inequality that hardens into permanence. This is the crime no one goes to prison for, not because it isn't destructive, but because it has been normalized into architecture. The greatest theft of the modern world didn't happen in the dark. It happened in conference rooms, with signatures, and perfectly legal ink.